there's also just some like underlying assumptions, okay, that we're making about the world, um, and the business that's kind of producing these financial statements. The first one, economic entity. Okay, there has to be something that we're tracking the accounting of. Okay, um, it could be an individual person. You as an individual are an economic entity. You have a bank account. You own certain things, um, but we have to have something that's defined that we can track what's going in and out of, what it owns. There has to be something, okay, and it has to be clearly defined. There are some small business owners that will have some corporation that they set up, and then they have their like personal expenses and the stuff that they own personally. That's kind of violating this because there's no clear delineation between their personal financials and accounting versus the business. And so if you presented the business's financials and it had all this other stuff mixed in, it's not going to be accurate. Okay, so we're assuming that there's a clearly defined entity that we're accounting for. We're also assuming that this entity is going to continue to exist. Okay, because as we mentioned, like this matching principle, right? We buy the van and we're going to spread it out. We're going to spread the expense of that van over a number of years. There's like an underlying assumption that the business will exist for those 5 years, right? If the business is imminently going to be like going into bankruptcy, then a lot of the accounting rules won't they're not going to make sense. Okay, so there is an underlying assumption that there is a future for our economic entity. Because if there wasn't for the van, if you knew tomorrow that this company that bought the van is going to go out of business, you would probably expense all the van right away. So, this is kind of an underlying assumption. You're also assuming that the financial statements and the accounting are done in some stable form of currency or money. During periods of like hyperinflation, the price of like food changes from the morning to the evening. Okay. So imagine if you're trying to present a 1 year financial statement, it's just going to be incoherent. So you have to have some way to measure what's going on in the business in some stable unit. And if that's not the case, then you're not going to really produce anything meaningful. It's going to be uh, the financial statements will not be interpretable in some economically meaningful way. And finally, time period. We are going to divide our businesses up into discrete periods of time. For example, if we had an income statement, right? Revenues minus expenses equals profit. The New York Times has been around for, I think, since the 1850s. Okay. Would it be helpful to you if I showed the revenues and expenses of the New York Times from 1850 to 2025 in just one income statement? Is that going to be useful to you as someone that wants to know about the business of the New York Times right now? No, right? What do you care about? Current, right? You want the last quarter, the last year, right? So we're going to divide the business up. We're going to have stopping and starting points where we kind of have a cutoff. We're going to see what the business owns, who it owes money to, uh, from the last cutoff till now, how much revenue it's generated, how much expenses it's incurred. And so we're going to have these discrete time periods. Because if we didn't and we just like, left everything open, it's not going to be meaningful.